From downtown Milwaukee, welcome to Money Talk with Bob Landis. Each week, professional advisors from Landis & Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
This is Money Talk for the 11th of April, and here's what's happening. The Brewers are spending the weekend in Phoenix with the Arizona Diamondbacks and back home with the Detroit Tigers Monday, Tuesday, and Wednesday. And the Milwaukee Bucks are getting hot just in time for the playoffs that start next week. A voice of Milwaukee's musical past, Corky Siegel, is at the Anodyne Roasting Company. And if you prefer dance, and who wouldn't, the Milwaukee Ballet presents Sleeping Beauty at the Marcus PAC tonight through Sunday. All right, a small town in Japan has created a hot trading card craze. It's not baseball players or other athletes, but of senior citizens in their town. You have to be at least 65 to get your face and statistics on a trading card. Stats like marital status, number of kids, number of grandkids, and hobbies, etc. I can hear it now. I'll trade you one grandpa for two grannies. Now we have a couple of stories from jolly old England. The first is a woman was bounced from a Ryanair flight because the airline's credit card reader didn't work and she had no cash, but she ordered a tube of Pringles and ate them. Oh, the nerve. Police officers escorted this wanton woman off the plane and put her on the back of their van. They probably took her to Pringles prison. And finally, parishioners in northern England are discussing how to increase attendance at Sunday services. They decided that pro wrestling is just a ticket, and now you can't find a pew to sit in at church. It's called wrestling church. That's what they call it. I believe their patron saint is Hulk Hogan. On the podcast today, we have Steve Giles, Adam Baley, Joel Dracing, and wrapping up the week, here's Kyle Tetting.
And what a week it was, Max. The NASDAQ up 7.3% this week. That's 1,137 points. The S&P up 5.7, up 289 points to close at 53.63 on Friday. And the Dow Jones Industrial Average up 5%, closing at 40,213, up almost 1,900 points on the week after adding 619 on Friday. The news Monday, I think, was more of what we had come to expect. We saw a pretty sharp decline at the open on Monday and one kind of real quick headline that said, hey, maybe we're going to get some negotiation. All of a sudden, markets rallied, moving from meaningfully negative to meaningfully positive. I mean, hundreds of points in move on the S&P. And in the span of minutes, oh, no, never mind, that headline was wrong, and the markets were back down. And then it took us until Wednesday and a midday announcement that President Trump would be pausing the tariffs for 90 days. Other than on China, the rest of the world's tariffs now delayed for at least a couple of months here while we go on negotiating. And the markets seemed to rally through the end of the week, a bit of a rough day on Thursday, but half-day Wednesday and into Friday, really strong recovery. Adam, it gave us a market that by the end of the day on Friday looked at least a lot better than what we had looked last week, if not still meaningfully down for the year.
Yeah, there's only a single piece of focus for the market this weekend. It was trade war, the way we started it, and ultimately trying to move through it through the rest of the week. It was good to see after what was a precipitous drop the past several weeks. NASDAQ, Dow, and the S&P all putting together a solid rally from where we were. Talks of potential some deals to be made. Still our biggest partners, Canada, Europe, and China. Deals seem elusive at this point, but it's good to see the markets start to respond positively and try to move past this.
And Steve, we always talk about balance, and we always talk about kind of the role that stocks and bonds play in a week in which the S&P was up more than 5.5%. It's almost a surprise that in many ways bonds caught the bigger headlines. You had a massive increase in the 10-year U.S. Treasury rate, moving from just below 4% now to 4.5%. That's a 52 basis point move on the week, the biggest we've seen in decades. And I think investors may be a little concerned about what that means for the bond piece of their portfolio.
Yeah, bonds are usually the safe place for investors when they're looking for something that's not as volatile as stocks. And as a nice counter to the volatility that comes with owning stocks, you've got bonds. However, all these tariffs and concerns with inflation have led to higher rates. Instead of a safety in bonds, you're getting concerns with volatility and the potential that maybe bonds aren't as safe of a place to be because of the China trade and because of this higher inflation component.
Yeah, it's so interesting to me that we did see bonds hold up pretty well in the early days of the tariff conversation and how quickly it pivoted to higher rates. I've seen headlines calling into question the relative safety of the American dollar, calling into question the role that America traditionally played in periods of market volatility. I'll remind our listeners that of the 21 meaningful governments that issue 10-year bonds, we're not the lowest yielding nor the highest yielding. We're right down the middle in terms of yields, far outstripping the vast majority of the Eurozone, far outstripping the rates we get in Japan. And so even if we're not as safe as we thought we were, even if we're not the reserve currency down the line, even if we are a less safe bet from a buying treasuries perspective, I got to tell you, 4.5% on a 10-year treasury is still a pretty good deal for investors, especially when you consider it within the scope of what you can get buying stocks. That the comparison point that we've been talking about for years on what's my interest rate on bonds versus the earnings yield, what I get in earnings for $1 put in the S&P 500, is a pretty tight range right now. And Adam, maybe that makes bonds, despite the fact that we are occasionally questioning what role do they play, maybe it does still make them a pretty attractive alternative at 4.5 compared to 1.5 or 2.
Yeah, they are offering competitive returns against stocks these days, especially when stocks are so volatile. You can get 4.5% on a U.S. Treasury. You can get probably just a little bit more on a newly issued corporate bond. But part of the issue that we were facing with the Treasury market is you can see some of our trading partners likely stepping away from buying U.S. Treasuries. Means prices decline. Could also be a worry that maybe this inflation is going to stick around for a little bit, and also could be a worry that maybe economic momentum slows from here. You put all those three things together is the reason why prices have fallen, yields have gone up. But the flip side is you get paid a little bit more to hold that bond.
Well, and you don't want to get rid of your bonds. I think the critical component to all of this conversation is the quality of your bonds. Obviously, higher quality issues are going to be a much safer alternative. The same way we look for high quality stocks and blue chips at times of uncertainty and times of heightened volatility, you want to look for high quality bonds too.
Yeah, and now is a wonderful time to be migrating to higher ground and higher quality for your bonds. We saw some spread widen in high yield. I know, Kyle, you got some thoughts on that. That kind of played out this week.
You know, I wish it was enough of a widening that it made buying the lower quality stuff attractive, and that's always the challenge. Is there are these narrow windows in which we can actually look at certain parts of the bond market and go, hey, there's some return potential there that looks like the equity market. Normally we count on our bonds to be the safe piece, but every once in a while you can, bottom fish, you can, pull from the bottom of the barrel and go, hey, here's a deal. We're still not there. And so I think, Steve, your point earlier about the bonds are the safe piece, that's still the case. If we see some continued pressure in the bond market, if we see some widening of credit spreads again, maybe there's an opportunity. But I'd say for now, yeah, it's not an area I want to be fishing, because if I'm looking for risk in a portfolio, I'd much rather buy stocks right now. There's so many great deals we're seeing in a lot of different areas. I'm going to tell you, they could become better deals. In fact, it wouldn't surprise me if we get some more news next week, the following, 3 months from now, whatever it looks like, that gives us a little bit more uncertainty about where things are headed. But at the same time, I think a good reminder that sometimes in the midst of all that uncertainty, you get some of your best days. Wednesday was one of those, right? That when you look back over 100 plus years of market history, well, that Wednesday trading day was top 10 in terms of total return, and the best day we've ever seen for the S&P in terms of kind of total point increase. Not a fair way to measure things because the S&P is a much bigger number than it was 100 years ago, but it was a big day for investors that you didn't want to miss out on.
And it's a great reminder, Kyle, for why you don't want to try and time the market. Everybody on Tuesday that sold because they couldn't put up with the volatility or the market going down missed out on Wednesday's rally. Build a portfolio that has an allocation that will weather any kind of storm. That way you're never on the sidelines and miss the kind of up days we saw Wednesday.
A 9.5% swing in the S&P 500 in the span of a day. And you could be completely right about your concerns and completely right about long-term where things are headed and completely wrong about the right day to do it. And so trying to time especially these markets, I think it's a fool's errand. You know, Joel, we got a highly anticipated number on inflation kind of middle of the week this week. It was, at least on the surface, a fairly encouraging reading, gave us some hope that maybe the Fed doesn't have to be quite as concerned about inflation. It's a month, and so we've got to kind of start the conversation by saying, hey, let's not ring the bell yet that everything's fine, but I think at least on the surface it was an encouraging number, but I know you've looked a little deeper there.
Yeah, and as Adam said, I mean, it didn't really matter much because the trade war was the single focus. But yeah, we got good news on Thursday for the Consumer Price Index, which is the broadest measure of inflation that we have. It showed that inflation is actually back to where it was 4 years ago. That's pretty amazing. When we had in mid-2022, we had 9% inflation. Last month in March, we had 2.7%. So that's progress. I'm sorry, it was even 2.4%. So that's even closer to the Fed's long-term goal of having 2% inflation overall. But it is only a month. A lot of the analysts I read, when those numbers came up, a lot of economists are saying it might not mean anything. We don't know how the trade war is going to affect prices, what that's going to do for folks. But that 1 month, that one snapshot is encouraging. It also was followed by the Producer Price Index, which looks at inflation on a wholesale basis. That came out this morning. And that showed that, so the CPI showed that the year-to-year price for eggs went up 60%. It's at an all-time high, $6.23 average for large grade A dozen of eggs in March. And the again, 60% up from a year ago. But the Producer Price Index showed that eggs actually went down in March. So that might be a cost savings that's going to be passed along, and lo and behold, we might have cheaper eggs in a month or so.
Well, you're speaking to the retail versus the wholesale prices of eggs.
Yeah, but
is an important
a lot
distinction.
of times the retail follows the wholesale, not always, but and not to the same degree. But there's some hope there from the wholesale that 21% drop in egg prices in March.
And our listeners need to know that you had a groan-inducing line in your economic data summary this week that
Thanks
egg
for
prices
noticing.
had boiled up 5.9% from February and March.
I also said something about the price of eggs dropping.
Yes,
So,
you did, and maybe
yeah.
a good time of year for egg prices to come back down a little as we get into the egg dying season. But, from a consumer perspective, not as happy with where things are headed. And, of course, all the surveys we're talking about right now predate a lot of the rest of this conversation.
Sure, and then that's the distinction between hard data and soft data. Those consumer price indexes are
one
hard
has
numbers.
a runny yolk and the other...
Yeah, you're the one making the yolks now. But today we got consumer sentiment numbers from the University of Michigan, and they're preliminary for April. In fact, they're so preliminary that the interviews that they based the survey on took place before the April 2nd announcement of what the trade policies were. But consumers were historically down on the economy, on their personal finances, and the report said it was across the board. They used the term pervasive and unanimous as far as who's not feeling good about the sentiment of the economy right now. Just to quote the report, it says, consumers report multiple warning signs that raise the risk of recession. Expectations for business conditions, personal finances, incomes, inflation and labor markets all continued to deteriorate this month. That's so far in April. It was down for the fourth month in a row. It's down 30% from December. It had so they ask, what's your expectation of inflation a year from now? and people gave the 6.7%. Expect that, I just said it was 2.4%. They expect 6.7% a year now. A year from now, that's the highest expectation since 1981. One other thing in that is that more consumers are expecting unemployment to go up to the degree that it's the most elevated since 2009.
Yeah, there's no way to sugarcoat the consumer sentiment number this week, and it comes after just a precipitous drop so far this year. Actually, when I first saw the number, I thought it was a misprint, and I had to go back and to check, and no, it's true. But why this is important is consumers are clearly down. They're clearly glum. They're clearly strained with all of this. And 70% of our economy is driven by consumer spending. When we go to the grocery store, gas station, replace broken dishwashers, which the Baley family had to do not too long ago. It's the regular consumer spending that drives the vast majority of our economy. And if you get consumers this worried, the worry then is that they back off on some of that regular spending, and economic growth could be hurt.
And Adam, not to sugarcoat it, but to offer a spoonful of sugar to take with it, is that a lot of times sentiment doesn't mean much.
Yeah, consumers say one thing and do the other. I mean,
but especially that unemployment expectation is a big one, because for the last several years they haven't expected unemployment to go up, and that's sort of emboldened them as far as their spending concerned. One little anecdote I saw today, a report from Bloomberg News, that hairdressers are reporting that people don't want to spend as much money on their hair treatment. They're saying they're either canceling appointments, or they're saying, don't do my do as much as you used to do, because I want to save the money.
Yeah, and perhaps we might see that out on the streets then in a way we haven't before, if more people are dealing with the long hair instead of getting it trimmed up tight.
We got to grow it out again.
I think it's probably time for that. And Joel, a fairly quiet week on the economic front. We're just getting into earnings season here. Going to be a lot more information next week. And one of the things you pointed to in some of your pre-show notes was that we'll know, I think, a lot more about the consumer we've been talking so much about when we start to get into the retail sales release next week.
Right, and that's, again, looking back. All these things look back. All the hard data, looks back, but that's going to be retail sales for March.
And I think March, a pretty good indication of how people felt leading up to the tariff announcement. And then, we're still a month out from what did people do in response to at least the initial announcement. And then, again, more to come thereafter.
And some of that might be in anticipation of higher prices.
What I'm really interested in seeing is some of the earnings announcements, and maybe even tuning into some of the earnings calls. I like to do it with just large global multinational businesses to get a sense on business environment. But we're going to be getting into the real meat of earnings season within the next 3 weeks or so. And businesses will give their estimation on how all of this is going to impact their own earnings as they see it out in the future. We don't have that information now, but in the next 3-4 weeks, we'll have a lot more at our disposal.
Yeah, at least for now, earnings forecast still pretty rosy through the end of the year, a pretty nice jump, and I think we'll have to adjust that as we get more on the earnings front.
Sunny side up?
Sunny side up. Steve, we don't always get to the more practical pieces of, maybe how investors should be thinking about their investments, but you and I were talking right before the show about some clients that I know you've talked to. I had a similar conversation this week, and just about the importance of making sure that you check in on your beneficiaries every once in a while.
Yeah, and this is not just beneficiaries on your IRA accounts, which you are obligated to have. You can't open up an IRA account unless you list your beneficiaries. But assets that are not in some kind of retirement account, like an individual brokerage account or a joint brokerage account, if you don't have a trust, you should be considering the TOD designation, transfer on death. Some banks call it the POD designation, payable on death, so that everybody knows the intention of where you want that money to go when you're not around anymore. Everybody talks about wanting to avoid probate. Well, this is how you do it. Put beneficiaries on any account that does not have the requirement of a list of beneficiaries, and those would be bank accounts, investment accounts, mutual fund accounts, so that everybody knows where you want that money to go.
Yeah, and I think be clear with your beneficiaries at some point in time that when the day comes, here's where to look for what I have, here's who to talk to, whatever that conversation is for you. But Adam, I know we like to have those conversations long before it becomes an issue.
Yeah, and as much as we talk about reviewing investment strategy, you also need to be reviewing your estate planning strategy on a somewhat regular basis. Sit down and review that yourself and take a look at who is going to be the beneficiary on your accounts. If you have a partner, make sure the two of you sit down and just making sure that the transfer of your assets plays out the way you want. And if there's been any change in your family, you always got to go back to the drawing board and just revisit your estate plan if it still fits your needs and goals today.
Well, certainly some scrambled markets the last few weeks, and I think as we move into the weekend, encouraged that we're doing it with a bigger number. As always, we enjoy doing the program for you. We'll talk to you next week.
Thank you for listening to Money Talk with Bob Landis. If you have a financial question you want answered on next week's show, email it to moneytalk@landis.com. To keep informed throughout the week, visit our Money Talk page at landis.com.